Okay, so you've done it. You launched your startup, people are buzzing, and that first check is finally in hand. It feels like a golden ticket, right? Proof you're on to something big. But what if that money, depending on where it came from, is actually sending a warning to the big investors you'll need down the road? Let's unpack the hidden signals in your startup's first check.
I mean, it seems like the ultimate proof of concept. Hundreds, maybe thousands of people believe in your vision so much, they're putting their own money into it through equity crowdfunding. That sounds like the perfect story to tell a venture capitalist. But a really fascinating study shows this popular success story, well, it might not be what VCs want to hear at all. So first, let's talk about why crowdfunding is so appealing. It's basically seen as the great democratization of startup investing. No more stuffy gatekeepers, no more exclusive clubs. It's just you, your big idea, and the public. You get to prove there's real demand by getting the market itself to fund you. It's a pretty powerful story.
And that's really the heart of it, isn't it? It feels like this direct, unfiltered signal that you've got market fit. If the crowd is willing to buy in, then your startup has to be a winner. For a lot of people, that's a compelling argument, and that's where the story ends. But for venture capitalists, that's just the beginning.
All right, now let's flip the script and try to think like a VC. Their world is just constant information overload, total uncertainty. Their whole job is to sift through thousands of pitches to find those few golden needles in the haystack that will deliver huge returns. To do that, they need shortcuts. They need signals to help them spot high-potential ventures and filter out the noise.
And this is where a concept from economics called signaling theory is absolutely crucial. The basic idea is that when one person knows a lot more than another, like a founder knows their startup inside and out and an investor doesn't, the informed person can send credible signals to prove their quality. For a VC, where you got your very first check is one of the most powerful signals you can possibly send.
You know, a really simple way to think about this is like a letter of recommendation. A glowing letter from a Nobel laureate is going to carry a lot more weight than one from your cousin Bob, right? It's the exact same idea with funding. The source of that money acts as a third-party endorsement, and believe me, VCs pay very, very close attention to who signed that letter. So that brings us to the main event. How does that letter of recommendation from the crowd stack up against the more traditional endorsements, like, say, a government grant or getting into an elite accelerator program? Well, the research puts them head-to-head, and the results are pretty eye-opening. Just think about the contrast here. On one side, you have crowdfunding. The investors are often everyday people, not professionals. They might put in a little money based on passion or because their friends did, with pretty limited due diligence. But on the other side, you have grants. These are awarded by experts after an incredibly competitive, rigorous, merit-based review. The agency giving you that grant is putting its own reputation on the line. That sends a really strong signal of quality. And the gap gets even wider when you compare crowdfunding to a top accelerator, like a Y Combinator. See, the crowd gives you money. That's great. But an accelerator? They give you capital plus world-class mentorship, structured training, and access to an insane network. Just getting in is a huge battle, and graduating basically acts as a certification that you've been vetted and shaped by experts. So when the researchers analyzed hundreds of startups, the data was just crystal clear. Startups that came out of accelerators, they were the most likely, by far, to get that next big round of VC funding. The ones who won competitive grants came in a strong second. And the startups whose main signal was a successful crowdfunding campaign, well, they were significantly less likely to get that VC investment. The signal from the crowd, it turns out, just isn't as loud. But hold on, it's not always that simple, is it? What about the team? I mean, surely a world-class team of founders can make a difference no matter where their first check came from. So the researchers decided to test this. They introduced what they call the human capital factor. This is the big question, right? Can an absolutely brilliant team overcome a weaker signal? If your founders are just top tier, does that make a VC overlook the fact that you were crowdfunded? Let's see what the data has to say. First off, what do we even mean by human capital? Well, it wasn't just some vague idea. The researchers looked for specific, measurable things that signaled team quality, like having founders with PhDs, which points to deep technical expertise, or having an MBA, or even just having a larger founding team. Okay, so here's the first interesting twist. The research showed that for those crowdfunded companies, having a strong team, specifically founders with PhDs or just a bigger team, it did help. It actually helped close the gap, making them almost as attractive to VCs as the startups that had won grants. So yes, a great team can definitely strengthen a weaker signal. But, and this is a huge but, That same boost from a great team was not enough to close the gap with the startups that came from top accelerators. The signals sent by an accelerator, which isn't just about betting, but also intense development and networking, is just so powerful, so all-encompassing, that even an all-star team on its own couldn't fully replicate it.
So after digging through all this data, what's the big takeaway for founders, for entrepreneurs, heck, even for investors? It really all comes back to being intentional about the kind of signals you're sending out into the world. Let's just boil it down to 3 key things. First, your early funding is never, ever just about the money. Second, you have to see it as an endorsement that tells a story to your future investors. And third, as we've clearly seen, the quality and credibility of those stories can be wildly different. The story told by a grant or an accelerator is simply more convincing to a VC than the one told by the crowd.
The researchers themselves put it perfectly. They said, the legitimacy and perceived quality of these signals differ. It's so simple, but so true. In other words, not all money is created equal in the eyes of the next person writing you a check. The path you take to get that first bit of funding really sets the stage for every conversation you'll have after that.
So at the end of the day, the choice is yours. Crowdfunding can be an amazing tool for raising money and proving people want what you're building. But when you're thinking about your long-term vision, it's absolutely worth asking yourself, what story is my funding strategy telling? And is it the story that's going to open the doors I really want to walk through next?